Welcome to A.G. John Show. Tonight, we are stepping into a moment that markets will remember not because of a single headline, but because of the silent math underneath it that just changed direction. $5 trillion is not a number you skim past. It is a gravitational field that pulls currencies, bonds, equities, and commodities toward it, whether investors like it or not. When that much value is suddenly exposed to policy risk, every portfolio on Earth feels a tremor, even if the screen still looks calm. China's latest move did not come with fireworks or emergency meetings broadcast on television. It arrived quietly through structural decisions that most traders only notice after the price has already moved. The real story is not what China said, but what China stopped needing to say. For years, global markets have operated on an assumption that China would absorb shocks, smooth cycles, and quietly recycle capital back into the system. That assumption is now being stress tested in real time. The shift underway is not about growth numbers or quarterly targets. It is about control over capital flows and the cost of financial dependence. Once a nation reaches that stage, market logic changes because political logic replaces it. If you're watching prices alone, you are late, because price is the final symptom, not the first signal. The first signal is always behavior at the policy level, where incentives quietly flip. China has been signaling for months that capital preservation matters more than capital expansion. And that distinction is everything. When preservation becomes the priority, risk is no longer distributed evenly across the global system. This is where the 5 trillion number starts to matter in a very real way. That figure represents exposure that was priced under one regime but is now living under another. Global investors built strategies, assuming liquidity would remain predictable, correlations would hold, and stress would be managed collectively. China's move suggests that assumption is no longer safe. Markets hate uncertainty, but they fear asymmetry even more. When one major player changes the rules, while others continue playing the old game, capital scrambles. The shockwaves you're seeing are not panic, they are recalibration. Money is not fleeing yet, it is repositioning. Repositioning is quieter than panic, but far more powerful. It happens before headlines catch up. China's action signals that domestic stability now outranks global accommodation, and that is a line that once crossed, rarely gets uncrossed. This is not an emotional decision, it is a strategic one. When a country reaches a size where internal shocks matter more than external approval, it stops underwriting the world's risk appetite. That is the moment markets must reprice everything. $5 trillion at risk does not mean $5 trillion disappears overnight. It means $5 trillion is no longer guaranteed the assumptions it was built on. Think of it like a bridge that still stands, but is suddenly weight restricted. Cars can pass, but nobody knows how many or how fast. Investors sense this intuitively, which is why volatility is appearing in places that were considered boring just months ago. Boring assets are only boring until they are not. China's move tightens feedback loops between currencies, trade balances, and debt markets. Once those loops shorten, reactions accelerate. This is why global markets are moving together instead of rotating independently. Correlation spikes when structural change begins. What makes this moment dangerous is not leverage, it is confidence. Confidence is what allows systems to stretch without breaking. When confidence weakens, systems snap back violently. History shows this pattern repeatedly, even if the triggers differ. China understands this history better than most because it has studied other empires that lost control through financial overextension. The lesson is always the same. Sovereignty follows balance sheets. The 5 trillion figure is best understood as optionality that just expired. Capital that once assumed flexibility now faces constraints. Constraints force choices, and choices reveal priorities. China's priority is clear, even if it has not been spelled out directly. Domestic financial insulation is now worth more than international goodwill. That is a rational decision for a system preparing for turbulence. Global markets were not prepared for how fast this transition would occur. Speed is what creates shockwaves, not magnitude alone. When policy moves faster than capital can adapt, mispricing explodes across asset classes. That is what you're witnessing now. The bond market feels it first because bonds price trust and time. When either becomes uncertain, yields move before headlines do. Equities follow because future earnings are discounted through those same yields. Commodities react because they sit at the intersection of growth and currency value. This is why the reaction feels everywhere at once. It is not chaos, it is alignment. China's move also forces other nations to confront uncomfortable questions about dependency. No system likes discovering its weakest link during a storm. 5 trillion at risk is a message as much as a number. It tells policymakers globally that assumptions must be revisited quickly. Markets will attempt to stabilize, they always do, but stability after a regime shift looks different than stability before it. Old floors become new ceilings. Investors who mistake this for a temporary scare will be the most exposed. Temporary scares bounce, structural shifts grind. Grinding moves wear down conviction and force exits over time. That is how large reallocations happen without a crash headline. China is not trying to shock markets, it is trying to protect itself. Shock is simply the side effect of scale. At this size, every move becomes global, whether intended or not. That is the burden of financial gravity. The 5 trillion number also reflects leverage embedded across derivatives, funding markets, and cross-border balance sheets. These layers amplify even small directional changes. Amplification is what turns policy into price. Without it, markets would shrug and move on. What you should be watching now is not the daily candle, but the weekly structure of capital flows. That is where the real story is unfolding. Funds are shortening duration, increasing liquidity buffers, and quietly reducing exposure to long-dated assumptions. That behavior speaks louder than any analyst note. China's latest move compresses timelines. Decisions that could be delayed before must now be made. This creates pressure on central banks that were already juggling inflation, growth, and political expectations. Adding geopolitical capital risk makes their job exponentially harder. Markets sense this fragility, which is why reactions feel nervous rather than decisive. Nervous markets oscillate before they choose a direction. The danger zone is when oscillation turns into trend. Trends built on structural change are difficult to reverse. 5 trillion at risk is not about loss, it is about repricing. Repricing is painful because it forces acknowledgement. Acknowledgement that the old playbook no longer works. Acknowledgement that safety was conditional. China has effectively reminded the world that global markets are a convenience, not a guarantee. Convenience disappears under stress. This is why long-term investors are reassessing what true diversification actually means. Correlation risk is the silent killer. If everything moves together, diversification is an illusion. China's move exposes that illusion. What comes next will not be decided by one press conference or one data release. It will be decided by follow-through. If China maintains this posture, markets will adapt. If it escalates, markets will fracture. Right now, we are in the adaptation phase. Adaptation is uncomfortable but survivable. The 5 trillion question is whether adaptation is enough or whether deeper realignment is required. That answer will define the next cycle. Investors who understand this are not panicking. They are patient, selective, and increasingly defensive. Defense does not mean hiding in cash forever. It means respecting that the rules have shifted. China's move marks a transition from expansion to consolidation at a global level. Consolidation always reduces excess. Excess was plentiful for a long time. That is why this moment feels shocking. Shock fades, but consequences remain. That is the part markets struggle with most. As this plays out, narratives will change daily, but structure will not. Structure moves slowly but relentlessly. 5 trillion at risk is not the end of the system. It is a warning label. Warnings are only useful if read early. Most will read it late. A few will act on it now. This is not about fear. It is about awareness. Awareness is the most valuable asset in moments like this. China has made its move. The world is now responding, whether it admits it or not. What you do next should be based on understanding, not emotion. Emotion reacts, understanding positions. Stay focused on flows, not noise. Noise is loud, flows are honest. This moment will be studied long after the volatility fades, because it marks a shift in who absorbs risk. Risk absorption defines power. As that power shifts, markets adjust their language from growth to resilience. Resilience is quieter, but more durable. The shockwaves you feel today are the first echoes of that transition. Echoes travel farther than the original sound. It will unfold through subtle confirmations that the old anchors are no longer holding weight. Markets will search desperately for reassurance, but reassurance cannot exist when the source of stability has consciously stepped back. What makes this moment uniquely dangerous is that it coincides with already elevated global debt levels. When debt is high, tolerance for uncertainty is low. China's move effectively removes a shock absorber that many did not even realize they were relying on. Once removed, every bump in the road feels sharper and more destabilizing. This is why reactions appear disproportionate to the headlines themselves. The headline is small, the implication is massive. $5 trillion at risk represents years of accumulated positioning built on the belief that globalization was irreversible. That belief is now being challenged at the highest level. Reversal does not mean isolation, it means selectivity. Selectivity is far more disruptive because it forces competition for access. Capital hates competition when it comes to safety. When safety becomes scarce, premiums explode. You are already seeing this in the widening spreads between similar assets that used to trade in lockstep. When spreads widen, trust narrows. Trust is the invisible currency that holds markets together. Without it, liquidity becomes conditional. China's policy shift introduces conditions where there were none before. Conditions slow everything down. Slower systems are more fragile because momentum works against them. Momentum is only friendly in expansion. As expansion gives way to protection, narratives must be rewritten. The problem is that portfolios cannot rewrite themselves overnight. This lag between narrative change and portfolio adjustment is where damage accumulates. Losses rarely come from being wrong, they come from being late. The 5 trillion figure is also a reminder of how interconnected balance sheets have become. A change in one corner reverberates through derivatives, swaps, and funding arrangements. These instruments were designed for efficiency, not resilience. Efficiency collapses under stress. China understands this, which is why its move prioritizes optionality at home over efficiency abroad. Optionality is priceless in uncertain environments. Markets that lose optionality become brittle. Brittle markets break suddenly. This is why policymakers elsewhere are watching closely, even if their public statements remain calm. Calm language is often used when contingency plans are being drafted quietly. Behind closed doors, risk committees are reassessing exposure models that assumed stable Chinese participation. Those assumptions are now questionable. Once assumptions break, models follow. And when models fail, forced selling is never far behind. Forced selling is not driven by fear. It is driven by rules. Rules do not care about narratives. China's move increases the probability that rules will be triggered across global institutions. That is the true systemic risk. 5 trillion at risk also intersects with currency dynamics in a way that markets have not fully priced yet. Currency stability depends on confidence in flows. When flows become unpredictable, hedging costs rise. Rising hedging costs reduce profitability. Reduced profitability tightens financial conditions, even without rate hikes. This is stealth tightening. Stealth tightening is dangerous because it is harder to diagnose. By the time it is visible, damage is already done. China's decision accelerates this tightening by altering expectations rather than rates. Expectations are more powerful than policy tools. This is why central banks may find themselves reacting instead of leading in the months ahead. Reaction is always more expensive. Global markets are now operating with less margin for error. Small mistakes will carry outsized consequences. $5 trillion exposed to repricing is not a cliff event, it is a slow burn. Slow burns exhaust participants psychologically. Exhaustion leads to capitulation, not panic. Capitulation is quieter, but more final. You will know capitulation has begun when volume dries up instead of spiking. Silence is the tell. China's move also forces corporations to reconsider supply chain financing structures. Financing was built on predictability. When predictability fades, costs rise. Rising costs eventually hit earnings. Earnings revisions are the bridge between policy and equity prices. That bridge is now under strain. Markets may attempt rallies along the way, but rallies inside structural shifts tend to be sold. Selling strength becomes the dominant behavior. That behavior reinforces downward pressure without dramatic headlines. This is how wealth transfers happen quietly. 5 trillion at risk also has political implications beyond economics. Domestic audiences matter more during uncertain times. China's leadership is optimizing for internal legitimacy rather than external validation. That choice reshapes incentives. When incentives change, cooperation becomes transactional instead of assumed. Transactions introduce friction. Friction slows growth, even if no one intends it to. Intentions matter less than outcomes. The world grew accustomed to a system where capital always found a home. That system is now being rationed. Rationing capital is the opposite of globalization. It introduces hierarchy. Hierarchy determines who pays more for funding and who pays less. Markets are allergic to hierarchy because it exposes weakness. This is why reactions feel emotional even when driven by logic. Exposure makes people uncomfortable. China's move is a reminder that sovereignty and markets are not opposites. They are intertwined. When one asserts itself, the other adapts. $5 trillion sitting at that intersection is enough to reshape asset allocation frameworks for a generation. Generations remember these moments. Veteran investors will recognize the pattern, even if the players differ. The pattern is always withdrawal before repricing. Withdrawal does not mean disappearance, it means discretion. Discretion limits visibility. Limited visibility increases volatility because uncertainty expands. Expansion of uncertainty is poison to leverage. Leverage unwinds slowly at first, then all at once. Timing that transition is nearly impossible. This is why disciplined risk management matters more than bold predictions right now. Survival beats brilliance. China is not signaling collapse, it is signaling caution. Markets misinterpret caution as weakness until proven otherwise. Weakness and caution look identical at first glance. The difference only becomes clear with time. 5 trillion at risk will test whether markets can adapt without breaking. Adaptation requires humility. Humility is rare during long bull cycles. It is rediscovered during transitions. You should expect narratives to oscillate wildly as participants search for certainty. Certainty will not arrive quickly. Instead, clarity will emerge gradually through behavior. Behavior never lies. Watch where capital is willing to accept lower returns in exchange for stability. That is where fear is being priced honestly. China's move shifts that calculus globally. Stability premiums are rising everywhere. Rising stability premiums mean lower valuations across risk assets. This does not require a recession to occur. Markets can reprice purely on risk perception. Perception often moves faster than reality. The 5 trillion question is whether reality will eventually justify the repricing or contradict it. Markets will test both. Until then, volatility is not a bug, it is a feature. Features persist. This moment is not about predicting exact outcomes, it is about understanding direction. Direction matters more than destination in capital preservation. China has altered the direction of risk flow. Everything else follows. If you are waiting for confirmation in the headlines, you will receive it after the move has matured. Confirmation always arrives late. Those who adjust early do not look smart immediately. They look cautious. Caution is rarely rewarded in the short term. It is always rewarded in the long term. 5 trillion at risk is not meant to scare you. It is meant to wake you up. Awareness precedes action. The global system is entering a phase where protection outranks participation. Participation will come at a cost. As costs rise, inefficiencies will be exposed. Exposure forces change. Change is uncomfortable, but it is also inevitable. Markets resist inevitability until resistance becomes impossible. China's latest move accelerates that timeline. Acceleration compresses mistakes. This is why patience must be paired with vigilance. Passive complacency is no longer safe. Every cycle has a moment where assumptions crack. This is that moment. What follows will define winners and losers, not by intelligence, but by adaptability. Adaptability is the ultimate edge. $5 trillion at risk is the price tag of ignoring structural shifts. Those who recognize it early pay less. This is not the end of global markets. It is the end of global certainty. Certainty was always an illusion. Now the illusion is fading, and reality is reasserting itself. Reality is uneven, political, and unforgiving. China understands this reality and has positioned accordingly. The rest of the world is now catching up. The shockwaves you feel are not overreaction, they are adjustment. Adjustment is the market's way of breathing. As the system exhales, weaker structures collapse first. Stronger ones survive and consolidate. This consolidation will not be announced. It will be observed in hindsight. Hindsight always pretends it was obvious. Right now, it is not obvious, and that is precisely why this moment matters. Moments like this separate noise from signal. Stay focused, stay disciplined, and stay ahead of the narrative rather than inside it.